So happy December. Hard to believe it's December already. Shopping season, aka Christmas, is now, I guess, officially in full swing. Although if you walked into any store the past 30 days, you probably saw a bunch of Christmas decorations, but it is clearly in full swing now. We hope that your Thanksgiving was good and plentiful and an opportunity to take a moment to recognize and be thankful for all that you and I have in this wonderful country that we live in. So on this week's show, we thought we would sort of continue the Thanksgiving theme, not quite ready to transition to Christmas, even though everybody else has. The reality is that we're going to go and take a second helping, if you will, of leftovers from a couple of topics that Kristen and I talked about on last week's show before Thanksgiving. And then we're going to take a moment and talk about what is and continues to be one of the least understood moves to make in retirement. But unfortunately, it's perhaps one of the most pervasive recommendations to retirees. Even the Wall Street Journal, in an article here last week that a couple of listeners forwarded to us, wound up going into details on that. So we're going to help to shed light on this media frenzy, internet craze of sorts of really pushing the conversation about Roth conversion. So welcome on into this week's episode of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also a top 25 financial planning podcast. If you're looking to connect with us on your favorite podcast platform or on our YouTube channel, just search Nelson Financial Planning, or if you want to hit the easy button, go to our website at nelsonfinancialplanning.com. There you'll see the icons in the upper left-hand corner. We've got a newly redesigned website as well that we rolled out just this past week, so make sure you check that out as well. Upper left corner, there's a bunch of icons. Whichever one looks most familiar to you, click on it, and you'll get automatically redirected over to that particular platform, and our channel will appear on that particular platform. Once you're there, make sure you subscribe so you don't have to do that again, although we love it when you visit our website. So, but anyway, that's easier. Subscribe, and that way you get notified when we upload new content. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. So definitely check out the newly designed website. While you're there, you can schedule a free conversation or take us up on our holiday offer of our book, Next Gen Dollars and Cents. Available absolutely free. We'll get a free copy in the mail, and then that way you can give the gift of achieving financial success to a loved one. Talk about a great gift. So speaking of holiday season, we're going to shift to our leftovers, if you will. Last week on the program, you knew that fellow certified financial fiduciary and certified financial planner, she's also a CPA, Kristen Costello, joined us, talking a little bit about some of the information that we shared with our clients in the week before in sort of our regular educational meeting that we do every quarter. If you're a client of the firm, then you know that you get those opportunities. This last one was sort of a breakfast session, usually their dinner. And so we wanted to also sort of supplement what we were talking about last week with our perspective as well. So we didn't really kind of get time for that. Let me quickly recap some of the key takeaways from the presentation from a senior economist that we shared with you last week on the program. So, and this one really does, I think, bear repeating a little bit because it is an interesting concept and one that is relatively rare. So what we have going on right now is a little bit of a unique phenomenon in that you're actually getting interest rate cuts during an expansionary period. If you think about economically, typically the Federal Reserve cuts rates to help stimulate economic growth. More often than not, that occurs when there's not economic growth, when the economy is in a recession, and the Federal Reserve then cuts rates to help improve the economy by lowering interest rates, making it cheaper for businesses and consumers to borrow. So that's usually the pattern. But right now, it's somewhat unique because when you look at the economic data, obviously the economic data is pointing positively. So we're in an expansionary period. But lo and behold, rate cuts are happening. And I guess you have to sort of appreciate the uniqueness of that combination where the Fed, as it's striking the balance between inflation has clearly come down from where it was 2 or 3 years ago. When we say that, meaning the year-over-year change, not the cumulative impact. You can never reverse the cumulative impact of inflation, as anybody that goes to the grocery store this past week to get stuff for Thanksgiving can attest. You can't unwind the cumulative impact, but you can at least make sure that the pace of inflation isn't continuing on at the same pace as it was. So in that respect, the Federal Reserve has sort of weathered that inflation piece. When they look at the job market, you're right on the line in terms of sort of that full employment. So that gives them the freedom to be able to cut rates without having to worry about overstimulating the economy. History suggests, when you look at that unique combo, that it's fertile ground for continued growth. And the 14 other times where you've seen that, where the markets have been sort of at market peaks, where the economy is expanding, and then the Fed is cutting rates, average return over that subsequent 12 months is a positive 18%. So bodes well for what could be in the future. And then the other concept, which is, I guess, an oldie but a goodie, is that over time, when we think about investing, right? We think about investing, owning companies. We think about what the value of those companies is based on. Over time, it comes back to earnings, right? If you're not making any money as a business, eventually that's going to catch up with you. Maybe there's periods of time where you've got a great product and ultimately the market is really excited about the potential for future earnings of that particular company. But if those earnings don't pan out, then ultimately that's going to impact the price of that or the value of that particular company, the price of that particular company's stock. So the real concept is let's not forget about the fundamentals, right? Earnings and companies' abilities to make money ultimately drive exactly what happens in the valuation of that company over time. So two very important concepts that with 2025, a month away, really do help to start to put together our thoughts of what ultimately we could see play out in the year ahead. And I don't want to get too far in front because, if you're regular listeners of the program, we do a fearless forecast here at the end of the year. Right now, we're way ahead in terms of our fearless forecast for the year 2024. Market's much higher than even what we thought they might be for the year 2024. So some of this will be the foundation of that fearless forecast that you'll get in about a month or so here on the program, or exactly a month because it's December 1. But all of this sets up some level of optimism because of this unique period of time that we're in, where you've got an economic expansion and the Fed is cutting rates. Toss in things like the productivity gains of AI and the broadening profitability of different companies in different sectors. If you look at that third quarter earnings season, which obviously is fully complete now, 1,800 companies reported, about 2/3 beat expectation. So you've got a much broader profitability equation setting itself up in America. And then toss on that sort of the climate of deregulation that you might see under a different administration. All of that sets itself up well and certainly gives us reason for optimism. Of course, caution abounds with all these global hotspots, deficit spending. So there's always other things to watch out for, which is why we do the program every week, right? With that, we're going to take a break and continue on after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're doing sort of a Thanksgiving leftover show here this week on Dollars and Cents, talking about a little bit more detail about some of the concepts that we talked about last week. Last segment, we were talking about kind of the economic implications of where we are at, and that situation where you've got the Federal Reserve cutting rates and the economy expanding sets itself up pretty well for the road ahead. That's a very unique combination that is, in essence, putting a little fuel on the economic fire. Of course, as we were saying just before the break, got to watch out for all of those things that might send things sideways, right? A host of global hotspots that bear watching around the world. And then there is some concern about deficit spending. And when you look at what has been happening with the stock market and then compare that to the bond market really is, as interest rates have really jumped up over the course of the past couple of weeks or so, the bond market really is expressing some concern about just how much deficit spending is going to come out of the federal government. So certainly a to be continued discussion on that. I guess a good way to describe our thoughts as we start to think about 2025 would be a cautious optimism, I think, is a kind of a good way to express it, if you will. The other topic that we wanted to cover on sort of this Thanksgiving leftover conversation from our show before Thanksgiving, so last week's program where we were joined by Kristen Costello, fellow certified financial fiduciary and certified financial planner at Nelson Financial Planning, is this new requirement for small businesses in America, courtesy of the Corporate Transparency Act. So the Corporate Transparency Act was enacted in 2021, but went into a full effect here in the year 2024. It adds a regulatory filing burden on the more than 33 million small businesses in America, Nelson Financial Planning included. And that burden involves filing a beneficial ownership information report to the Department of Treasury through its Financial Crimes Enforcement Network. Obviously, given the name of, Financial Crimes Enforcement Network, the point of this requirement is to help ferret out illegal activity and terrorism, and so at the end of the day, that is its stated purpose. The reality is that, as Kristen and I talked about on the program last week, is that you do have to provide a variety of details about you as the owner of the company, from your birth date to copies of maybe your driver's license or your passport. There is not an annual requirement. Once you do it, you're done. But if something changes among the owners, whether it's like change of address or change of name because of a marriage or new driver's license, then you do have 30 days in which to sort of report those changes and update things. So there's certainly an ongoing obligation to keep the information current, but not like an annual thing where every year you got to go in and hit a button. So, again, not totally convinced that, the ultimately incredibly trustworthy federal government isn't going to use that information for something else. And yes, that is in fact sarcasm. But the other thing that we wanted to talk a little bit about is that, and I guess here's the punchline, some words of caution based on sort of that conversation of what you need to do in terms of this beneficial ownership information filing. And we had a number of listeners this past week sort of reach out to us. There's been a massive push and a massive campaign by private companies, okay, to sort of help, if you will, complete that information that you need to complete. And so this beneficial ownership filing, I'm looking at no less than 3 different sort of forms that either I got in the mail or listeners forwarded to us after they heard the program this past week. And I understand that there is certainly a process to filing this report. Okay. I get it. But let me assure you, it really is not that difficult. And Kristen touched on this a little bit last week. I decided, you know what? I'm going to go ahead and do it. Okay. And I'm going to go through this process. So since last week's program, I actually sat down and did the beneficial ownership information filing for Nelson Financial Planning, right? So it makes sense, right? Because we're a small business and we have to file. And so I went through the process. So it took, and I timed it. So by the time I got sat down in front of my computer, okay, logged in, okay, woke it up, it took me 15 minutes and 16 seconds. 15 minutes and 16 seconds from start to finish. Now, I had to find my passport. So all of this was in the middle. So I said, okay, I'm going to do it, and I'm going to start to finish and get an accurate number as to how long this thing is going to take. So, but all part of that, right, is if I got to upload my passport information, then I got to find my passport, and then I got to take a picture of my passport, and then I got to upload my passport picture to my computer, and then that way be able to drag and drop over to the federal government website at fincen.gov. I had to find the EIN number for Nelson Financial Planning. Don't know that off the top of my head. And then lastly, and I don't know if you've ever run into this CAPTCHA stuff that occurs at the end, like to prove that you're a human. I basically failed that. Apparently I'm not a human because I don't really recognize, where the traffic lights are, because it always makes me do it again. So with all of that in the process, still 15 minutes and 16 seconds. So not an excessive amount of time. I mean, let's face it, even with all of that sort of homework that you had to do in order to prepare for it. What I did do, and I would certainly recommend this, is this question 3 on this report that asked for a unique FinCEN number. It asked, do you want us to assign you a unique FinCEN number? And I think it's worth hitting the yes button on that, because I think that might be a better way to sort of track down that filing if you need to access in the future, particularly with this ongoing obligation that you must wind up keeping that filing up to date, so if there's any changes of address, driver's license, things like that. So I like the notion. I mean, obviously you can search it by your EIN number, but again, having an additional number, of course, that's one more thing you got to remember and keep track of. But I did check the box, and I think our general recommendation would be, yeah, you might as well check that box. Now, here's the trouble. Here's the punchline. So we're getting all these notices. Okay. I'm getting them, our clients are getting them, listeners to the program are getting them, and they are really charging you a lot of money that if you took 10 or 15 minutes, you could do it yourself. I mean, this is of the category that makes it sort of borderline scammy, or at least not fully represented in terms of what is at stake. And then, all of these notices that we're getting, oh, let us file your, FinCEN filing, let us file this on your behalf. The hook that they sort of really set is that it then takes the form of an annual fee, but there's not an annual reporting obligation on this thing. So here's one example, right? And I'm going to name names because, I don't care. I'm going to name names. And you need to know exactly what the specifics are and what to look out for. So this one comes to us courtesy of FinCEN Alliance. Oh, it sounds like they're allied and ready to help me, right? That sounds great. But it's $199, and it's an annual fee of $199. Now, I don't know, how you valued your time, but if you're willing to pay somebody $200 for 15 minutes of work, give me a call, okay? I don't think that's worth it, right? So $199, and then it's annual. See, that's the hook. Okay, it's annually. That's the part. So every year, then it becomes an ongoing thing. It's like a double Netflix subscription or something like that. We've got two more that we want to share because I really want to dig a little bit deeper in this, because this is the kind of stuff that you get in the mail and it seems legit, and it is, but you really don't have to commit to that kind of a cost when it comes to this. So we're going to continue on with this topic here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're doing sort of a second helping, little leftovers, if you will, after Thanksgiving. I'm sure you probably had a few leftovers around your house this weekend. Much like that, we've got some leftovers from the show we did the week before. And the key takeaway, which is really what we're chewing into now, is, look, this beneficial ownership information report that you, if you own a small business, you're required to file through the U.S. Treasury, through the FinCEN network. FinCEN.gov is where you go and file the report. You really can do it yourself. I mean, I sit down from start to finish to fill out that report for Nelson Financial Planning, right? That's an entity that I own. And so go through the process. And it took me all of 15 minutes and 16 seconds. From the time I went to the computer, tried to warm it up, logged in, got to the right website. Most of the time was spent trying to figure out where the heck my passport was because I couldn't find it. And then tracking down the EIN number for Nelson Financial Planning, not exactly a number I know off the top of my head. And then taking the pictures and getting through the CAPTCHA stuff and things like that. The reality is, though, what we've also seen is sort of these helpful, and I use that word in quotes, companies that are literally flooding inboxes, emails, and mail with offers to help. But these offers to help are pretty expensive and are really meant to sort of capture you, or I guess more importantly, capture your money, and not actually really generate a benefit that is comparable to the amount of work that is actually involved, right? So, like I said, it took me 15 minutes and 16 seconds to do the BOI report for Nelson Financial Planning. But here we go, right? This one came in the mail, okay? So, so we're not going to quite hold it up for the camera, but this one came in the mail. FinCEN Alliance. Oh, let us help you. You got to do this. You're going to get a penalty of $500 a day, which is true. The penalties are that much if you don't do this. Let us help you. Let us help you. And nowhere on it does it say how much it costs, but when you go to the website, it's an annual fee of $199. Now, remember, there's not an annual filing report on that. So that's one of them. Then this next one is another one I got in the mail as well, addressed to me, Joel Garris, 423 Country Club Drive. That's the office address. And here we go. This is a filing immediate response requested, final attempt. Okay, so obviously intended and designed to spur you to action, or at least to open it up and not just throw it away. This one is another one from the folks at FinCEN Alliance. Final notice, $500 penalty per day, must file by the end of the year. So annual fee of $199. Here's another one. This one came to us courtesy of a listener forwarding an email that they got. This one is formfiling.com. Went to the website just to see how much they were charging for this, beneficial ownership information report. Couldn't figure it out. Nowhere. I mean, had to literally put all your information in. I'm sure the costs would pop up at the end. This third one is compliance clerk. You got to make sure that you're compliant and penalty free. We'll make it so easy for you at a mere $149 per year. And again, once you sign up for it, it's an annual thing. So then you can't really get too unwound. I'm sure the process of canceling it is more difficult than trying to cancel like a Netflix subscription. That's for sure. So, key takeaway here, folks. Key point of this part of the conversation is, I understand you're getting flooded with requests to let us help you. The reality is that I really want to encourage you to take the time, like I did, and get online and try and do the report yourself. Don't commit to a sort of an annual fee of $200 a year. That's just really excessive, especially in relation to what the process is to file that beneficial information report. Take a shot at filing it. You go to the website, it's fincen.gov/BOI for beneficial ownership information, and give it a shot. Really try and avoid using one of these services that are just going to charge you a crazy amount for 10-15 minutes worth of work, and then commit you to an annual subscription that you don't really need to know. So be careful about that. So that's our follow-up from last week's program. We're going to shift gears here in just a second, but welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including whether you want to commit to some annual service at $200 a year or give it a shot and file your own beneficial ownership information report for your small business. We're one of Central Florida's longest running radio programs, coming to on a host of stations throughout the region. Also a top 25 financial planning podcast. So make sure you check us out over on the podcast world, along with our YouTube channel at Nelson Financial Planning. Any trouble finding, go to our newly designed website at nelsonfinancialplanning.com. Upper left-hand corner, you'll see all the icons. Click on them. They'll immediately connect you over to our channel on that particular platform. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well, that stand ready and able to help you improve your life with a successful and cost-effective financial plan. While you're visiting our website, maybe to schedule that free consultation, make sure you take us up on our free offer this holiday season to get a free copy of our book, Next Gen Dollars and Cents. Great gift for a loved one or maybe even yourself to help you maybe achieve financial success by developing some good habits, or just simply getting a better understanding about some of the different financial concepts out there that can certainly impact your dollars. So this next section is going to be a conversation about what we're seeing out there in the world at large that really talks an awful lot about this notion of Roth conversions. There's so many different articles out there about this. There's TikTok videos. There's all kinds of stuff, including an article in the Wall Street Journal just this past week or two that a couple of folks forwarded to us. So we thought we would want to spend a little bit of time just sort of talking this one through, because far too often the headline that you see, so for example, the Wall Street Journal talks about it being the move that adds years to a nest egg. Okay, so that would mean like you'd look at it and say, wow, that's certainly something that I want to do. So the headlines really are pretty dramatic. And ultimately, be careful on this Roth conversion stuff. I mean, it's simply not really the end-all, be-all that everyone says that it is. And the problem is that our concern, and we see it a lot with folks in the office, is that they're just doing these conversions without necessarily fully running the numbers. And the number of people that are sort of jumping into this Roth conversion sea, if you will, has really increased. I mean, here are the numbers. So during the past 12 months, ending in July, according to the folks at Fidelity, Roth conversions grew by 45%. In the 3-year period from 2017 to 2020, which is apparently the latest year for which the IRS data is available, which obviously amazes me. Here we are in 2024, and you're telling me the data only exists for 2020, but whatever. There was a sharp increase. In 2017, 137,000 people did Roth conversions, totaling about $4.4 billion. In 2020, 300,000 people did it, converting a total of $14 billion. So federal government loves it when you convert, because if you do the math and let's say that that's at the 22 or 24% bracket, 14 billion gets converted. Well, then that's an extra $4-ish billion in revenue revenue to the federal government. I assure you that they did great things with that money. So don't worry about that part at all. But the promise of big tax savings in most cases is illusory at best and simply fails to account for what retirement reality is for the vast majority of Americans. So we're going to break that down in greater detail after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So let's paint the table. Everywhere you turn, everybody is saying you need to convert your IRA to a Roth. Okay, Wall Street Journal had an article a couple of weeks ago saying it was the move that adds years to a nest egg. Well, we deal with real people at the office every day at Nelson Financial Planning, and I can tell you, whenever we run the numbers on this, because when we do, we run an actual tax return analysis. Put the data into an actual tax return, see what it actually spits out. 9 out of 10 times. Okay, it just doesn't make a whole lot of sense. The reality is that when we think about the retirement income picture for the vast majority of Americans out there, it's not nearly this giant issue that it's being made out to be in the mainstream media and on various platforms throughout. So let's set the table first and just make sure we understand what we're talking about when we talk about Roth conversions, because we run into folks that have come to the office that didn't quite understand what exactly it was. So we'll start with the fundamentals. When you put money into an IRA, traditional kind of retirement platform, right? That money is often done on a pre-tax basis. So you saved on your taxes when you put the money in, right? Okay, that's the IRA. When you take it out, then you got to pay taxes on it, right? So that's the deal, okay? You saved up front, you pay when you take it out. That's the IRA. The Roth is the flip of that. Okay, so the Roth, you pay taxes now, and then when you take it out down the road, then there's no taxes on it. Okay, so you can see where each one of them, certainly independently, has a lot of pros and cons. What we would always say is that if you're in a lower tax bracket, then yeah, it makes sense to do the Roth instead of the traditional, because if you're in a low tax bracket, then you don't necessarily need maybe as much of those tax savings as possible, although that can cut the other way, because if you're trying to get started with investing and you're not making a lot of money, maybe the tax savings helps to spur you to save a little bit more money than you otherwise would. So you can see where there's no perfect answer on, which option to pick. The Roth conversion is the concept of I'm going to take money that I funded years ago into an IRA, and I'm going to convert it all over to a Roth. And so when I do that, then ultimately, that means that I am going to pay taxes. That's the key catch, right? You got to pay taxes. So if you convert $100,000 from an IRA to a Roth, then okay, perfect. You wind up having to then report and pay the taxes all in a single year. You don't get to spread that out over a few tax years. There have been times in the past where you did, but that doesn't apply anymore. And so you pay all of the taxes for the entire amount that you converted. Okay. Just as an aside, by the way, let's just let you in on a little thing on this one. When do you want to convert when the market's high or when the market's low? Stop and think about that for just a second. You want to convert when the market's high or you want to convert when the market's low? When the market's high and you're converting, right, then that $100,000 when the market is high, you're converting less shares. Versus if the market was low, you'd be converting more shares and effectively accomplishing much more if the market were different. So before you just jump into this stuff, it's important to think through exactly what it is. So if you converted $100,000 IRA to Roth, you paid taxes on $100,000, what if the market goes down 20%? Right? Then you just paid taxes on money that you don't have anymore. Get the point? Might not want to necessarily jump into that, particularly when you are at market highs. That's a side note. Let's come back to the primary note. the amount that you convert when you do IRA to Roth, that's going to be at your highest marginal bracket, right? Because it's going to get layered in on top of the other income that you have. And that can create some ripples involving additional taxes, particularly if you cross certain thresholds. It can create more tax on your Social Security. It could even increase the cost of your Medicare as well. And the reality is, and these articles that push this Roth conversion, they're all making and stoking fear of, oh, you're going to have that required minimum distribution. That required minimum distribution is going to create so much of a tax burden that you really need to deal with it now. Well, here's the deal, okay? The vast majority of Americans are satisfying that required minimum distribution well before they get to required minimum distribution age. Why? Because if you retire and you take income out of your portfolio, then that's the distribution. And so as you're taking that, chances are that you're already satisfying the required minimum distribution amount. Because remember, it's a minimum amount. It's a threshold amount that at the end of the day, if you take out at least that much, then you don't have to worry about it. And so for the vast majority of Americans, when they retire and they start to get regular income in retirement, for about 90% of them or so, then you're already satisfying your required minimum distribution. So the RMD is not going to necessarily add, some giant extra amount to your situation. And remember the RMD rules. It starts at 73, but if you're age 66 or younger, your required minimum distribution age is not until 75. I mean, don't forget the age is going up. So right now it's 73 is the required minimum distribution age. If you're younger than 66, your required minimum distribution age is 75. So I don't know that you got a problem. And then if you're retired and you're taking income, look, this is certainly something worth checking into. I'm not saying it's not, okay? Absolutely. You always want to check into whenever the opportunities might be to improve your finances. No question at all on that. But please make sure you are running a full tax analysis. Take the time to do that before you just randomly do that. The required minimum distribution is not a monster in the closet. For the vast majority of people that are retired, you're already satisfying it. So it's not some additional giant amount that you've got to take out of the account. It basically works to being less than 4% a year, which if you're taking income from a retirement account, chances are you should be probably staying in that range anyway. So by that very nature, you will satisfy the required minimum distribution. Isn't that interesting how that works? The reality is make sure you're running the analysis. I will tell you, we do it all the time for our clients, 9 out of 10 times. Okay. It's just not worth it. Okay. And it's just not, not worth it. So take the time. Don't buy the headlines on the articles. So, man, packed show here. There was a lot of Thanksgiving leftovers plus some additional conversations about some of the things that are front and center in your inbox or in your feed these days. Certainly from an economic perspective, a very unique time when you talk about a growing economy and a Fed that's cutting rates. That's a pretty interesting combination of times. And then this beneficial ownership report. Look, really try and do it yourself. Okay, it took me 15 minutes and 16 seconds for Nelson Financial Planning. That involved finding my passport, taking a picture, uploading all of that kind of stuff. Be very careful with the flood of offers to help, if you will. You could very easily wind up paying $200 a year on something that's not an annual filing requirement. So be very careful on that. A flood of them hitting inboxes and mailboxes across the country these days. And then, of course, finalizing up with our Roth conversion. I don't think there's any other issue, certainly not an issue that's being talked about as much, that has a truly unique factor of an individual specific situation. So you really got to take a close look at that. So with that, we're going to start to wrap on up and get on out of here. So important, as always, to get perspective and advice on any of these issues. If you have questions, maybe on that BOI thing or whether a Roth conversion is right for you, give us a call to set up an absolutely free conversation at Nelson Financial Planning. We don't charge for conversations, and unlike so many other firms, we don't have account minimums because we actually believe in helping you no matter where you are on your financial journey. That's, after all, what being a fiduciary is all about. So with that, we will wrap it on up and get on out of here. This has been Joel Garris of Nelson Financial Planning, and you're listening to Dollars and Cents.